Welcome, and I want to express my genuine gratitude to you for taking the time to come and watch the video today. We know your time is valuable, and it is always a pleasure to have you here with us. Today, we are processing the latest financial breakdown from Flexsteel Industries.
Yes.
Specifically, we are looking at their Q2 Fiscal Year 2026 earnings call, which just took place on February 2nd. Okay, let's unpack this.
It is great to be here. And, when you look at the raw source material, this presentation truly serves as a masterclass in how a legacy company navigates extreme macroeconomic turbulence.
Yeah.
We are talking about an environment defined by wildly shifting consumer habits, ongoing economic uncertainty, and incredibly aggressive tariff policies.
It's a lot to deal with all at once.
It really is. Watching how Flexsteel's management handles these overlapping crises is an absolute must for anyone interested in corporate strategy, supply chain management, or honestly just survival in a tough retail market.
To kick things off with the company's prepared presentation, CEO Derek Schmidt and CFO Mike Ressler really didn't sugarcoat anything.
No, they did not.
They painted a picture of a very choppy external environment. I mean, they acknowledge that housing activity, which normally drives furniture sales, is totally stagnant right now.
Right, people aren't moving, so they aren't buying new sofas.
Exactly. Consumer confidence is completely erratic, and discretionary spending is incredibly inconsistent. But despite all those massive headwinds, their actual numbers were surprisingly strong.
Very strong.
So let's start with the top line. What are the key financial results we need to understand for this quarter?
Let's look at the revenue first. Their net sales hit $118.2 million for the quarter.
Okay.
That represents a 9% year-over-year growth. Now, in isolation, 9% is a solid number, but context is everything here.
Right.
This marks their 9th consecutive quarter of year-over-year sales growth.
Oh, 9 quarters.
Yes. Achieving over 2 straight years of consistent growth in a market where many furniture and home goods retailers are struggling just to keep their doors open is a massive win. You have major competitors closing showrooms or filing for restructuring, yet Flexsteel is consistently expanding its top line.
9 consecutive quarters in a choppy environment where consumers are hesitant to buy big-ticket items is definitely something to write home about.
It really stands out.
But, growth doesn't always equal profit,
Very true.
especially if you are slashing prices just to move inventory off the floor. What about their profitability metrics?
That is actually the most impressive part of the report. Flexsteel reported a GAAP operating income of $9.0 million, coming out to about 7.6% of their sales.
Okay, that's a healthy margin.
It is. But the real standout metric is their adjusted operating income. When you look at the adjusted figures, their operating income actually increased by a very impressive 35% compared to the prior year.
35%, that is a
Yeah.
huge jump.
It translates to an expansion of 150 basis points. In lay terms, for every $100 of furniture they sell, they are keeping an extra $1.50 in pure profit compared to last year.
Oh, wait.
They are not just selling more furniture, they are operating so efficiently that they are making significantly more profit on every single unit they move.
Expanding margins by 150 basis points in a high-inflation, high-tariff environment is no small feat.
Not at all.
And it sounds like their balance sheet is practically a fortress right now, which gives them a lot of strategic breathing room.
A fortress is a great way to describe it.
They ended the quarter with a cash balance of $36.8 million and absolutely zero bank debt.
A zero.
But looking at the numbers, there was one detail that jumped out at me regarding their working capital.
The spike in inventory.
Yeah, it intentionally spiked to $126 million because they purposefully built up a massive safety stock of their top-selling products.
Mm-hmm.
I have to play devil's advocate here.
Go for it.
Isn't tying up $126 million in physical inventory incredibly risky? I mean, if consumer demand suddenly drops off a cliff, they're sitting on warehouses full of expensive sofas they can't move.
It is a calculated risk, but a brilliant one when you look at the macroeconomic context. It is exactly like stocking up your pantry with non-perishables and bottled water right before you know a massive winter storm is about to hit.
Okay, I like that analogy.
The storm, in this case, was a wave of impending new tariffs scheduled to hit the supply chain on January 1st. By intentionally inflating their working capital and bringing in that inventory before the deadline, they successfully locked in their costs at a much lower tariff rate for those top-selling items.
Ah, so they beat the tax hike.
Precisely. Yes, it requires tying up a massive amount of cash, which is exactly why having zero bank debt is so crucial. That fortress balance sheet gives them the liquidity to make these defensive preemptive strikes without over-leveraging themselves.
That makes perfect sense. They saw the forecast and they went to the grocery store before the prices surged. Because Flexsteel isn't just surviving this storm. They are actively gaining market share while their competitors are scrambling to absorb those new taxes.
Right. Their competitors are playing catch-up.
And part of that resilience comes down to what they are actually selling. They noted in the presentation that 30 to 40% of their overall sales are currently coming from brand new products.
Which is a very aggressive innovation pipeline.
Yeah, they aren't just coasting on their legacy catalog. Plus, they are successfully diversifying their offerings, pushing heavily into health, wellness, and case goods to ensure their growth isn't dependent on just one single seating category.
What's fascinating here is what they decided to do with their forward-looking guidance in light of all this.
Right.
Or rather, the total lack of it. Despite the strong numbers, the massive cash position, and the strategic inventory wins, management explicitly stated they are pausing their forward-looking guidance.
Which is pretty rare for a publicly traded company doing this well.
It is. They are basically telling Wall Street, look, the market is simply too unpredictable right now to make promises we cannot mathematically guarantee.
And a big part of that unpredictability comes right back to the sheer weight of those incoming tariffs, doesn't it?
Precisely. They are very candidly bracing the market for margin dilution in the second half of the fiscal year.
Because the pantry eventually empties out.
You nailed it.
Huh.
While they had that pantry stocked with lower cost inventory for the second quarter, eventually that safety stock runs out. In the second half of the year, they are going to have to start selling higher cost inventory that is fully burdened by massive 25% tariffs.
Ouch. 25% is a heavy hit.
It is. Even with peak operational efficiency, the sheer mathematical weight of a 25% tax on their incoming supply chain is going to compress their profit margins.
So they're just getting out ahead of it.
Yes. They're setting expectations now so that investors aren't caught off guard when that mathematical reality catches up to them in the next few quarters.
It's a very transparent approach, setting the table for the turbulence ahead. Now let's transition into the Q&A segment of the earnings call.
This is always revealing.
It is, because this is where the executives truly have to think on their feet, and the analysts start pressing for the real story behind the numbers. For this call, we had Anthony Libidzinski from the firm Sidoti driving the questions.
Yes, and he really dug into the mechanics of their strategy.
He certainly did. His questions highlighted the underlying tensions in the broader retail market right now.
Absolutely.
Let's look at the first question. The analyst was Anthony Libidzinski from Sidoti. To give you a brief summary of his question, Anthony essentially wanted a breakdown of the revenue increase they just reported.
And 9% growth.
Right. He pressed them on the quality of that growth, asking how much of that revenue bump was actually driven by selling more physical units versus how much was just a result of price hikes being passed on to the consumer.
It's a very sharp question because it separates organic demand from inflation.
Definitely. What was their response?
In response, CFO Mike Ressler revealed that tariff-related pricing actions actually accounted for about $9.5 million of the revenue for the quarter.
Wow, so a huge chunk of the growth was just price hikes.
Exactly. When you strip that $9.5 million away and look strictly at unit volumes, they were essentially flat overall compared to the prior period.
Interesting. So they aren't actually moving more boxes overall.
Not overall, no. However, CEO Derek Schmidt jumped in to add some crucial nuance. He noted that their soft seating business actually saw tremendous unit growth, which is incredible considering they had to raise prices on those exact items.
So consumers still wanted that premium comfort and were willing to pay the higher ticket price.
Yes, but that growth in soft seating was entirely offset by a brutal 50% drop in their home styles ready-to-assemble business, along with declines in their made-to-order seating.
That paints a fascinating picture of a K-shaped consumer base.
It really does.
You have one demographic that is totally willing to pay a premium for high-quality core comfort items, and another demographic that is pulling back aggressively on budget, ready-to-assemble categories.
Exactly. It is a very polarized market right now.
Moving along, for his second question, analyst Anthony Libidzinski from Sidoti pivoted to innovation.
Yes, the new product pipeline.
Right. To summarize his question, he asked for more details about the exact portion of sales coming from new products. And he heavily pressed management on what their 18-month product pipeline actually looks like going forward.
And the company's response to this was arguably the most revealing moment of the entire call.
Oh, completely.
Garrick Schmidt confirmed that new products consistently make up 30 to 40% of their sales, a trend that has held steady for the last 6 to 8 quarters.
Which proves it is a sustainable strategy.
Yes. But then, Schmidt dropped a bombshell.
He did.
He flat out refused to give Anthony any specific details about what is coming in their 18-month product pipeline.
Which analysts usually demand to hear.
Right, his reasoning. He stated that their competitors are actively using artificial intelligence to rapidly clone their physical designs.
Here's where it gets really interesting. I mean, you and I discuss AI all the time, but almost always in the context of software coding, data processing, or content creation.
Yes, digital fields.
But the idea that AI cloning is a tangible, immediate threat in a heavy physical manufacturing industry like furniture, that is wild.
It is wild, and it completely collapses the traditional moat of hardware research and development. Think about the legacy product life cycle for furniture.
How'd it used to work?
Well, you design a sofa, you build a physical prototype, you take it to an industry showcase like the High Point Market, you show it off to retailers to secure orders, and then 6 months later, it finally hits the showroom floor.
Right. It was a very slow physical rollout.
Exactly. But Schmidt is essentially saying that if they tease a physical design too early today, a competitor can take a single photograph of that sofa, feed it into a generative AI tool, and that AI will instantly reverse engineer the physical dimensions.
That is terrifying for a manufacturer. The AI can just generate the 3D CAD models, spit out the exact manufacturing schematics, produce a bill of materials, and send it directly to an overseas CNC router.
You've got it. A competitor can literally rush a cheaper knockoff into mass production before Flexsteel's original design even leaves the shipping container.
That fundamentally changes how a physical goods company has to operate.
It does. It forces a traditional legacy hardware company to operate with the extreme paranoia and secrecy of a tech giant releasing a new smartphone.
Like Apple keeping the new iPhone under wraps.
Exactly like that. They have to keep everything under strict lock and key, hiding their physical shapes and fabrics until the exact moment the product goes to market, because software has fundamentally weaponized hardware piracy.
That is just incredible to think about. Okay, moving to the third question. Anthony Libidzinski from Sidoti wanted to know about retail expansion.
The distribution strategy.
Yes. To summarize his question, Anthony asked about potential new wins for the business and the prospect of expanded distribution within their strategic accounts. He was basically looking for where the future retail footprint growth is going to come from.
And in response, management explained that Flexsteel has intentionally aligned its business model to focus heavily on just 20 large, omni-channel capable independent retailers.
Just 20. That seems like a very tight focus.
It is. They are not trying to scatter their products across every small storefront in the country. They are targeting the specific retailers that are best positioned to win in today's digital and physical hybrid market.
The ones who can actually drive massive volume.
Right. While they already have deeply established relationships with the vast majority of these 20 accounts, Derek Schmidt highlighted that there are a handful of what he called emerging relationships.
Emerging, meaning they are just getting their foot in the door.
Yes. In these specific target accounts, the company sees ample room for what he literally described as exponential growth. They believe they are currently under-indexed on the specific showroom floors and can capture significantly more retail real estate.
It's the classic 80-20 rule in action. Focus all your energy and resources on the top-tier partners who actually have the omni-channel infrastructure to move the needle, rather than spreading yourself too thin.
Exactly. Maximize the partnerships that yield the highest returns.
Makes total sense. For the fourth question, analyst Anthony Libidzinski from Sidoti brought the focus right back to the biggest threat on the horizon.
The tariffs.
Yep. To summarize his question, he pressed them on their confidence in their ability to offset these looming 25% tariffs going forward. And he also asked the technical question about whether there were any favorable foreign currency exchange, or FX, impacts on their gross margin for the quarter.
This was where management really had to temper expectations and face the math.
It's hard to out-strategize a 25% tax.
It really is. To summarize their response, Mike Ressler explained that for the second quarter, they successfully mitigated the tariffs through a combination of thoughtful, targeted pricing actions, and aggressive internal cost cuts.
Right, but that was the lower tariff tier.
Exactly. He reminded the analysts that the inventory they sold in Q2 was only burdened with a 20%
You're
tariff.
right.
The harsh reality is that the second half of the fiscal year will definitely see margin dilution because the inventory they will be selling then is burdened by a much higher 25% tariff.
And there's only so much cost cutting you can do internally to offset a jump like that.
Exactly. They said the absolute biggest wild card right now is consumer unit demand. If consumers start buying because retail prices are forced too high, the math gets ugly very fast.
So what are they doing about it?
To fight this, they are actively working on midterm cost reduction initiatives and exploring alternative supply chain options outside the tariff zones.
Diversifying the manufacturing footprint. What about the currency question?
As for the FX question, Ressler noted that foreign currency impacts were completely immaterial for the quarter, meaning favorable exchange rates were not artificially propping up their impressive margins. It was pure operational efficiency.
It's a sobering reality check on the tariffs, though. They survived the first wave of the storm with that brilliant working capital strategy, but the second wave is coming, and it's a Category 5 tariff.
A Category 5 is right.
Finally, we have the fifth question from Anthony Libidzinski from Sidoti.
This was a bit more technical.
It was. To summarize his final question, Anthony noted that the company's tax rate came in noticeably higher than Wall Street expected for the quarter. He asked why that was and what analysts should expect regarding the tax rate going forward.
CFO Mike Ressler's response was very straightforward, assuring him that this was merely a temporary accounting impact.
Nothing fundamentally wrong with the business.
Right. He explained it was due to a return of provision related to foreign taxes that hit during this specific quarter.
Return of provision. Can you translate that corporate jargon for us?
Sure. Basically, the company had previously set aside money, a provision, to pay expected international taxes. When they realized they didn't owe as much as they initially projected, they had to return that provision back to the balance sheet.
Oh, I see.
It temporarily skews the tax rate for the quarter and makes it look artificially high, but it has zero impact on the actual underlying health of the business. Ressler explicitly stated that the tax rate should normalize and fall right back in line with the expected full-year rate moving forward.
It is always good to clear up those little balance sheet anomalies so the market doesn't panic over a simple accounting adjustment.
Absolutely. The markets hate uncertainty, even if it is just a bookkeeping quirk.
Well, we have covered a tremendous amount of ground today, from the nuances of supply chain logistics and working capital, all the way to the sudden science fiction level threat of AI in the furniture space.
If we connect this to the bigger picture, the story of Flexsteel in this quarter is ultimately a definitive case study in corporate agility.
It really is.
They are navigating brutal macroeconomic headwinds, erratic consumer demand that fluctuates wildly from month to month, and the heavy compounding burden of aggressive tariffs.
Yet they're still growing.
Yes. Yet they are succeeding and growing their margins by 150 basis points because they have built a fortress-like balance sheet with zero bank debt.
Which lets them make those big pantry stocking inventory moves.
Exactly. They are making highly strategic, smart inventory plays, acting decisively before the market shifts. And, perhaps most importantly, they are heavily relying on continuous new product innovation to capture market share from competitors who are simply too slow, too rigid, or too financially strapped to adapt to this new normal.
It is a remarkable playbook for how to thrive when the external environment is doing absolutely everything it can to pull you under.
It is definitely a playbook other executives should be studying right now.
Well, we have reached the end of our time together today. I want to sincerely thank you, the viewer, for taking the time to watch this video and explore these complex business strategies with us.
We really appreciate you joining the conversation.
If you enjoy this breakdown and found it valuable, please click the like button, share the video with a friend or colleague, subscribe to the channel, and definitely stay tuned for our upcoming content. We have a lot more exciting material on the way for you.
Before we sign off, this raises an important question, and I want to leave you with a final provocative thought to mull over on your own.
Go ahead.
Building on Derek Schmidt's incredible revelation about competitors using artificial intelligence, I ask you to consider the broader implications. If a traditional, heavily physical goods industry like furniture manufacturing is already having to hide its upcoming physical designs to prevent AI from instantly cloning and reverse engineering them into CAD models and manufacturing schematics, how will intellectual property and competitive advantage be protected in the supply chains of tomorrow?
That is a fascinating question.
If physical form is no longer a barrier to digital theft, the very nature of product innovation and research might have to fundamentally change. Something to think about.